Hi there. In the last video, we've studied how to get cost of goods sold and ending inventory on the average cost method, FIFO and LIFO. One thing that you may have noticed and probably surprised is you can see that different methods result in different numbers, right? Cost of goods sold is the highest on the LIFO. As a result, the ending inventory is the lowest on the LIFO. On the other extreme, we can see that FIFO results in the lowest cost of goods sold and the highest ending inventory. What's the end result? What's the impact on these results? Cost of goods sold, where do you see? You see cost of goods sold in income statement, right? In income statement, you have sales and cost of goods sold, right? And then you have gross profit, and then you subtract operating expense, others, and income tax and the like. Then you have net income, right? And then you have net income. Again, on the LIFO, cost of goods sold is the highest. What's the impact on net income then? Under the LIFO, your net income is the smallest, right? Likewise, in your balance sheet, where do you find ending inventory? You find it under current assets. And we've seen that on the LIFO, the inventory is the lowest. Then we can say that on the LIFO, the total asset which sums up all of the asset items is the lowest. Again, on the LIFO, net income is the lowest and your total asset or current asset becomes the smallest compared with the other methods. Right? Then why is this so? What do you think? What results in this kind of highest cost of goods sold on the LIFO? It is because, think about that. If you need more time, pause the video. Yes, the reason is on the LIFO, the last things are first included in this cost of goods sold. Meaning, you see that the price level goes up and up and up from 10 to 11 to 12 to 13. As a result of the LIFO, the priciest ones are included in your cost of goods sold. While on the FIFO, the cheapest ones are included in the cost of goods sold, right? So in normal situations, normal meaning, normally an economy shows is in a inflation, right? Usually, normally. In a normal situation, when price rate is going up, usually LIFO gives you the highest cost of goods sold, resulting in the lowest net income. Okay, I'd like to say one more thing about this comparison among different methods. On the LIFO conformity rule, it is stated that your tax reporting should be consistent with financial reporting when it comes to inventory costing method choice. Okay, if you are choosing LIFO, then you are reporting the lowest net income. As a result, you can pay the least tax, right? If you choose this method for tax reporting, then you should choose also LIFO for financial reporting. Okay. Right. Then let's move on to LCNRV method, lower of cost or NRV, net realizable value method. Okay, what is that? The cost is the cost that you have developed based on using a cost method. Okay, you've got these costs, but it is possible that your costing is different from what you can realize from the market. For example, is there anybody who has bought a car ever? Well, probably you know the concept of the car price, meaning if you try to buy a car of, for example, model year 2021, then you should pay quite amount of money. But as of now, in year 2021, if you buy a model that is produced in 2018, even though it's new one, even though the car is not used at all, if the car is in the model of 2019, then probably you should pay much less than that. For example, my first car purchase was in year 2000, like 5 or 6. At the time, I bought Honda Accord. I bought it, but I bought the model of 2004. That's still a new car, but in 2006, I bought Honda Accord model 2004. You know what? At that time, Honda Accord 2006 was sold at like $20,000. But I bought Honda Accord, a new one, but model of 2004 at $1,400. Much cheaper than the price that was attached when the car was initially manufactured in 2004, right? In 2004, when the car was manufactured, it must have been attached with a price tag of $20,000. I bought it at $14,000, right? If the dealer reports that I have an inventory of 2004 Honda Accord as of 2007, and the inventory value is $20,000, then as an investor, I would feel that that's a cheating, right? That's fraud. Again, if your inventory costing is higher than your market value or net realizable value, then you should use the lower one. You should use the lower one, the minimum between these two. Okay. The accounting standards state that you should use lower of the cost or not net realizable value. Okay. This is from your textbook example of this is 104. Okay. Between the two, market value is higher than the costing. Then should you use market value? No. Accounting standards are taking the conservative approach, meaning you should use the lower one in any case. Even though the market value is higher, you should use the lower one. Okay. Then the lower of the two is this. The lower of the two is this. For a flat screen TV, satellite radio, DVD recorder, and DVDs, right? You should choose the lower one. 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 And then Yeah, and then you multiply the cost by number of units. And then your total inventory you're gonna report on your financial balance sheet is the total value after applying the LCNRV method. Okay. Right. Then we've finished the reporting of the inventory. And then on the next video, we will study some of the analysis of the inventory and then finish the chapter. Stay tuned.